My name is Niamh McCarthy. I'm a project manager and economist on the Orbitas team as part of Climate Advisors, and I'd like to welcome you today to the webinar. We're so glad you could join us today, and we're really looking forward to delving deeper into the topic of climate transitions and opportunities in the palm oil sector. The Indonesian palm oil sector is highly exposed to climate transition risks, which include policy, legal, market access, and technological risks. Because of its high export volume, emissions-intensive production, and the competition for land in high carbon stock or high conservation value areas, Indonesian palm oil is particularly susceptible to changes in climate policy, things like consumer demand, corporate sustainability initiatives, for example. Through economic and spatial modeling, Orbitas research has found that in a world that adequately limits global temperature from rising, up to 600 million hectares of agricultural land, which makes up about 10% of land globally, would revert to forests, putting pressure on agricultural producers. On the other hand, Orbitas analysis also predicts a potential $9 billion market value increase for Indonesian palm oil companies that optimally respond to climate transitions. As we saw at the COP26 in Glasgow this year, these risks are no longer hypothetical scenarios. Already, over 100 countries have committed to end deforestation by 2030, and companies are increasingly committing to no-peak deforestation or exploitation supply chains. The companies and the investors that recognize and mitigate these risks have significant opportunity to maximize market value through yield increases, through emission reductions, and profit-enhancing investments. But those that don't risk being left behind. Our panelists today will discuss both the risks and the opportunities related to climate transitions using research from both Orbitas Finance and ZSL SPOTT. The event will also bring in the perspectives of palm oil producers and investors to discuss this research, along with recommendations on how the industry can better prepare for climate transitions. Our speakers today include Mark Kenber, who is the Managing Director of Orbitas and the CEO of Climate Advisors UK. Mark has worked on environment, climate, and energy issues for over 2 decades across government, NGO, and private sector roles. Eleanor Spencer is also with us today, the Palm Oil Technical Advisor at ZSL SPOTT. Eleanor manages the palm oil workstream within the Sustainable Business and Finance Program at the Zoological Society of London, or ZSL for short. She also represents ZSL on the Board of Governors for the Roundtable on Sustainable Palm Oil. Vemund Olsen is a Senior Analyst in Sustainable Investments at Storebrand Asset Management. Vemund covers climate, biodiversity, and human rights, and he has a special focus on oceans and tropical forests. We're also honored to have Olivier Tichit, the Director of Sustainability at Musim Mas Group. Musim Mas is a global integrated palm oil products company, and Olivier represents Musim Mas in the Roundtable on Sustainable Palm Oil. He's also the co-chair of the Board Standing Committee for Standards, and he serves as treasurer in the High Carbon Stock Approach. Our webinar today will start with a presentation from Mark Kenber on Orbitas research findings, followed by a presentation from Eleanor Spencer on recent palm oil industry assessments published by ZSL SPOTT. We'll then move to a panel discussion with our 4 panelists, and we'll be taking questions from the audience through the Q&A option in your Zoom control panel. Please feel free to submit questions anytime throughout the presentation, and we'll get to them at the end. Finally, all attendee microphones will be muted throughout the webinar, and a recording will be made available by email to all registrants within the next few days. So to get started, let's move to a presentation from Mark Kenber of the Orbitas team.
Thank you very much, Niamh. My presentation today will draw mainly on a report that we published a couple of months ago, a deep dive on climate transition risks in Indonesian palm oil. The report you can find on our website, orbitas.finance, alongside the global report looking at a much more macro level that we published in March last year, and a deep dive on Colombian cattle ranching using a similar approach to the one I'm going to describe today, which we published in March this year. So please visit orbitas.finance to find those and other materials. Next slide, please. Orbitas is a center of excellence for research analysis looking at tropical agriculture, in particular climate transition risks in the tropical agricultural sector in all those regions where tropical agriculture, and particularly tropical commodity production, so commercial market traded goods, are a leading driver of deforestation. And our work is, we are not a campaigning outfit. We look to provide information, evidence, and analysis that will help investors, financiers, policymakers, and producers themselves make the optimal decisions as they look to balance increasing pressure on them to meet net zero goals that the world has assumed, while at the same time maintaining and increasing their profitability. So we do this taking a novel approach, pulling together a number of models that have been used in other contexts and calibrating them in a way that allows us to look both from the macro level right down through the sectoral, national, subnational, company, and even at asset levels. So look at what are the impacts of climate transitions for those companies that respond or don't respond, all the way along their value chains. And we do that looking both at economic and financial modeling, but also spatial modeling that allows us to look at different land uses and how land uses are likely to change under different climate change scenarios. And the analysis draws on the approach proposed by the Task Force for Climate-Related Financial Disclosures in using a range of scenarios which in this case model different responses in terms of, as you'll see later, in terms of temperature goals for a combination of climate policies, corporate responses, and consumer changes, as Niamh mentioned in her introduction. And we've built those both using global modeling, but also very much built, engaging local stakeholders who will have better access to data, a better sense of what policies and political changes are likely to take place within the sector, but also in shaping how we frame the results so that they are most useful for the different actors in a given country and sector. You might ask, why do we focus on climate transition risks? Many have said, surely climate risks themselves, the impacts of climate change, are much more important for tropical agriculture. And of course, physical impacts of climate change are absolutely vital for the future of agriculture generally, and tropical commodity sector in particular. But as we've seen in the energy sector, where organizations like Carbon Tracker have looked at what are the impacts, potential impacts of responses to climate change on oil and gas and coal companies' future, given that many of those companies, their corporate valuations and the security they use for loans is based on their reserves. And as Carbon Tracker pointed out, in conjunction, the world's oil and gas companies have 5 times more reserves that they wish to exploit than can possibly be burnt if we want to keep below 1.5 degrees. There are significant risk of asset stranding, and we've seen as a result a number of those companies forced to revalue their reserves, downgrade their reserves, and through engagement with their investors take on different strategies that are more aligned, if not totally aligned, with a net zero world. Now that was very clear in the energy sector, and Orbitas believes, and I think our evidence that I'll point out, I'll highlight some of in the course of this presentation, suggests that transition risks, if not felt in exactly the same way, are as important for the tropical agricultural sector as they are for any sector in the world. All sectors, as it says on the slide, are exposed to climate transition risks. But unlike in the case where the oil and gas sector, where most companies are either national oil companies or are listed on public markets and borrow through large financial markets, and therefore investors, analysts, and financiers are well aware of the climate transition risks, this is not the case with the tropical agriculture sector. A survey we did at the end of last year of 24 financial institutions with significant exposure to tropical commodity production, not a single one of them had a tool to assess the impact of climate transitions on the companies that they're lending to or investing in, or in the risk analysis that they conduct on their own portfolios and loan books. Hence, our hope is that the analysis that we're doing as Orbitas will not only shine a spotlight on some of those transition risks, but also encourage financial institutions themselves to either take our tool or develop their own tools to factor those climate transitions into their analysis. Next slide, please. So the Orbitas approach, as I mentioned, if we could move to the next slide, starts with a scenario, with the construction of scenarios, which here I've mentioned as global local scenarios. They take global scenarios using some of the work done by the IPCC and many of the scientific institutions that are fed into the Intergovernmental Panel on Climate Change to map a number of possible pathways that the world might take in responding to climate change. And then we've adapted, as I mentioned before, in conjunction with local stakeholders and experts to create local scenarios that build on those global scenarios, but make them more focused on what's likely to happen at the local sectoral level. And from that, we create global sector projections, which allow us to look at, to assess the amount of land that will be available for cultivation, as Niamh mentioned in her introduction. In the most aggressive scenario, one that keeps us below 1.5 degrees, we expect up to 600 million hectares, that's 10% of current agricultural land, to need to be taken out of agricultural production, either for bioenergy crops, but most importantly for reforestation and restoration. So that's at the global level. And then we can take those numbers and look at the industry level, what happens for, in this case, the Indonesian palm industry, both in terms of global trends, what is the likely demand and price of oil palm and related products likely to be, but also at the local level, what does that mean in terms of their response to restrictions on land use, carbon pricing, and so on. That in turn feeds into the spatial modeling, allows us to look at very granular level, what is the optimal land use or use of any given piece of land under the different scenarios, and therefore what's likely to be available and what's likely to be the best use of it. For example, conservation, restoration, or palm oil production. That allows us to calculate the net present value of land and therefore the potential value of concessions, whether they are planted or in some cases unplanted concessions. And that in turn feeds into asset cash flows and allows us to look at company valuations and the valuation of specific assets, and therefore allow both producers and investors and financiers to understand whether those assets are overvalued, undervalued, or even potentially stranded. Moving to the next slide, please. So as I said, we base our analysis on scenarios, and I won't go into a lot of detail of these because you can find them on our website and in the report. But as you'll see, there are 5 scenarios which range from doing absolutely nothing at all, i.e. business as usual, associated with kind of somewhere between 3 or 4 degrees of warming, which as we all know will be catastrophic, down to 2 scenarios for 1.5 degrees, strong ambition, which get us on the path that we need to avoid hopefully the worst impacts of climate change. And you'll see that there are different levels of mitigation policy, which include increased from no to increased carbon pricing, direct restrictions on land use, and also assumptions about likely demand for bioenergy. And we've tested with sensitivity the technological progress in the agricultural sector. There's much more detail of these scenarios and how we've constructed them in the report and in a technical paper you can find on our website. So moving to the next slide, please. So in the global analysis we did, you can see that under the different scenarios, there are pretty major changes in land use at a global level. So for example, in the 4 degrees business as usual scenario, deforestation carries on unabated for the next 80 or so years. We lose another 111 million hectares of forest. Whereas in the strong ambition scenarios, 1.5 degrees, we increase forest cover through natural regeneration, active restoration or reforestation between 280 and 411 million hectares. That's important in itself from a climate perspective, but it also has a corollary obvious impact on the available cropland. And if you look at the changes in cropland and pasture land, the more deforestation is in the high temperature increase scenarios, obviously there is much more availability of cropland. Whereas in the strong ambition where you're restoring and regenerating forests, obviously availability of cropland decreases, and in one of those scenarios by as much as 300 million hectares. In all cases, however, pasture land tends to decrease, and what this covers, conceals in some way is whether this is open pasture land or pasture land that is managed under an agroforestry regime. But in the case of the presentation today on Indonesia, that change in pasture land is less relevant. What's important is the decrease in available cropland and the increase in forest cover with the more ambitious scenario that you follow. Next slide, please. So those, as I mentioned, feed into local scenarios, which we have built 3 scenarios: historical, modest, and aggressive ambition for Indonesia, built in conjunction with Indonesian partners. And they are, roughly speaking, a 4, 3, and 1.5 degree target temperature. And you can see that across a whole range of metrics, how this changes from scenario to scenario. In the historical ambition, there are effectively no carbon prices, either at the global level for land use, whether that's a revenue, a price of carbon for restoring or conserving forests, or a cost of carbon for producers. And likewise, there's no regional carbon price either. That begins to increase as we increase ambition. And you can see, while in the modest ambition, 3 degrees, prices are still fairly low. In the aggressive scenario, those prices begin to increase up to 60, 70 or so dollars per ton of carbon. Now that may seem a lot, but if you look at what's happened since Glasgow, the climate negotiations in Glasgow, the price of carbon for some land use carbon credits through voluntary carbon markets already up to $15 or $20 a ton. So the numbers in the aggressive scenario are not extreme by any circumstances. And you'll see that that carbon price is not applicable to smallholders in the form of a price that they would have to pay for exploiting concessions. And we took that under guidance from local stakeholders that this was likely to be politically unfeasible to apply a cost to those stakeholders, those smallholders. As you'll see, global protected areas increase, as I said in the previous slide, and that translates into land use restriction for industrial actors, where the restrictions on conversion become increasingly stricter, as you would imagine, as we move from the historical to the aggressive ambition scenarios. And for the smallholders in this case, in the less restrictive scenarios, there are no restrictions on smallholders, but as we get to 1.5 degrees, there is no way of meeting that target unless restrictions on land access to virgin forest or unplanted land apply to the sector as a whole. And as you'll see, bioenergy demand increases as ambition increases. Next slide, please. And if I know I'm racing through this a bit, we don't have a huge amount of time, but please do refer to the report or ask questions if you will require more detail. So as we implemented those scenarios and ran them through the model, you can see, and we've just put a couple of examples of the historical business as usual scenario and the aggressive scenarios in here. And on the left-hand side, you can see how regional carbon prices increase much more dramatically under the aggressive scenario, as you would expect, than in a modest scenario. And what is that? The implications of that are that the opportunity cost of cutting down forest is far greater under the aggressive scenario. So you begin to assess whether you could actually make more money by conserving or restoring forest than you would by chopping it down and converting into an oil palm plantation, than you would obviously be the case in a modest or business as usual scenario. And that in turn has a knock-on effect on regional land value and land prices. As you would expect, the less land there is available for cultivation, the more expensive the land that is available becomes. And you can see this on the right-hand side here, where land prices increase by 300 or so % over the next 30 years in the aggressive scenario, compared to little over 50% in a more modest scenario. So again, that makes the use of land and choosing the optimal use of land far more important, because the imputed cost associated with the land value is much greater as well. And that's a first kind of key finding, is that land prices will go up, and therefore more efficient use of land will be essential regardless of your concerns about climate change. Next slide, please. So what are the results of the scenarios that we ran through? And these are some very high level figures. Perhaps the most dramatic figure, and please bear in mind, I caveat this with a comment that data on concessions, land use in Indonesia is not very good. There are several maps and lots of conflicting data, but we use the best data we could. And although the numbers may not be exactly right, we have confirmed that they are broadly in the right ballpark. So 3/4 of unplanted concessions, that's to say, those pieces of land that companies have a concession, have the permit in principle to use, but and have as land banks on their balance sheets, and in many cases use as collateral for loans, are at risk of becoming stranded. In other words, they're either stranded legally because they will no longer be allowed to use them, or the price of carbon that they can retain, the revenue that can be generated by conserving them will be greater than the palm oil, than they can obtained from palm oil. So 3/4 of unplanted concessions. Perhaps more concerning for those in the market at the moment are that 15% of current Indonesian plantations are on peat lands that could well be concessions that be cancelled for returning to peatland. And this is not an economic, this is likely to be a legal restriction. And we've heard some moves in this direction, though nothing concrete yet. As I mentioned, a large amount of land that could have been available for agriculture is no longer likely to be available for agriculture. And it's between 5 and 10% of agricultural land globally, and has a knock-on effect in Indonesia. And as I mentioned already, global land prices likely to rise by 50%, but by up to 300% or more in the case of Indonesia. That in turn, along with the carbon price, raises the emissions costs for tropical agriculture, and a large part of that, a third of that, is attributable to Indonesian palm oil. And we can see that just through the cost of land and the carbon cost implicit in the use of inputs, fuels, electricity, and so on and so forth, could push operational costs for Indonesian palm oil companies up by 15% in real terms. The risks, however, are counterbalanced in the next slide by opportunities. And the key message here is there are significant risks, but for those companies and those investors who work with the companies to adapt and mitigate these risks in advance, there are significant opportunities. If we could go to the next slide. There is always a silver lining to every cloud. Seem to have a stuck slide, but anyway, I'll carry on without the numbers. Oh, here we go. So as I mentioned, there are opportunities, and by acting optimally, Indonesia's palm oil industry could realize an additional 9 billion in value. And that's 9 billion above what its business as usual trajectory would look like. And why is that? Well, it's partly because I mentioned before, demand for palm oil is likely to increase, and we suggest by up to 50% over the next 20 or 30 years globally. Why is that? Because there are little or fewer, if any, substitutes for palm oil. There are certainly no oil crops that produce the yields and the same level of productivity as palm oil. If you want to substitute it with rapeseed or sunflower, you're going to need a lot larger area. So world is likely to continue to demand palm oil. The population is going to increase, incomes are likely to increase, and therefore that will push up demand and push up prices. So there is an opportunity for palm oil companies to benefit from that. But in order to benefit from that increase, and therefore the 9 billion in value, companies will need to adapt. They will need to improve yields very significantly in a sustainable way. With less land available, higher land prices, the only way to meet that increased demand is by increasing yields. And as I'm sure we'll hear in a moment, some of the larger companies have yields that are very close to the technical maximum, but a number of the smallholders who produce 40% of the fresh fruit bunches in Indonesia are well below those technical possibilities, and even well below global averages, and therefore there's an opportunity to increase yields sustainably. Also, we'll need to think about what are the other low carbon opportunities, and one in particular is the capture of methane, use of the biogas for cogeneration. Methane that would otherwise be vented into the atmosphere and lost can be used as a fuel, and that generates both an income stream by selling the electricity or the methane to the grid or to private users, or for self-generation, and therefore reducing electricity costs, which, as we know, will increase over time due to the carbon price. So improved yields, taking advantage of other opportunities, can enable palm oil companies to take advantage of that growing demand while keeping within the net zero pathway. Next slide, please. And just to give a couple of specific examples, the picture on the left, it compares a single mill with, on the left-hand side, one that has not implemented biogas methane capture and electricity generation, and the one on the right that has. And there are the three scenarios in grey, black, and green. And as you can see, under any scenario, it makes more sense for a company to invest in that methane capture and cogeneration than not to. And so one of the key lessons across our analysis is that it's not just a question of thinking what happens in the 1.5 degree world, whether you believe that's feasible or not. In whatever the scenarios, even the historical scenario where little action is taken, there are measures that palm oil companies and their finances investors can take, which will increase returns and increase enterprise value, and in this case by methane capture and cogeneration. And then if we look on the right-hand side at how exposed companies are to climate transition risk, we looked at two particular metrics on this, and two determinants of how well equipped companies are likely to be able to adapt. And one is oil palm yields and investment in improving yields. If you are at the top right-hand corner of this chart, then you are amongst the least vulnerable and most able companies to respond, because on the one hand, your yields are high and you're investing in improving yields. And on the other hand, on the vertical axis, your cost of capital is much lower. Because if you're going to invest in yield improvements, if you're going to invest in methane capture and other low carbon opportunities, that's going to require capital upfront. And we estimate up to 30% increase in capital. And therefore, those companies that are well managed, have access to low cost of capital, will be much more able to respond. Whereas those that have poor credit, low yields, are unlikely to be able to respond, and are those that are most likely to suffer from climate transition risks. And if we just go to the final slide, I'm going to skip over this, but I think it's, just under the ambitious scenario, you'll see that alongside the impacts on palm oil producers, we gain 3.8 million hectares in Indonesia of forested land by 2040, which generates a revenue, but also obviously combats climate change. So on the next slide, there are some recommendations. I think they're fairly obvious, and we can come back to those in the panel discussion later. So I think in the interest of time, I will leave it there and hand over to the next speaker. Thank you very much.
Thank you so much, Mark, for the fantastic presentation. I would just want to take a quick opportunity to remind you that you can submit questions through the Q&A function in your Zoom control panel at any time during the presentation. And now I'll turn it over to Eleanor Spencer to talk about the palm oil assessment results at ZSL SPOTT.
Great, thank you, and thanks, Mark, very much for that really interesting presentation. I will try and keep this quite quick. I think Mark's already really well covered the kind of risks here and why companies need to be looking at climate risk. I'm going to try and just add a little bit of context to that as to where we are currently with company reporting in the Indonesian palm oil sector on climate risk. If you could move to the next slide, please. So just to very briefly introduce what we do on this. SPOTT is a project under the Sustainable Business and Finance team at ZSL, and essentially is a free online platform that is dedicated to supporting transparency among upstream commodity producers. So we've been going since about 2014 and now assess over 200 companies across the palm oil, timber and pulp and natural rubber sectors, particularly upstream. So we're looking at producers, processors and some traders, and those that we believe have the most significant impact in these industries. Companies are assessed annually on the public disclosure of their policies, their commitments, key information about their operations, as well as their reporting on practices and implementation relating to those policies. And all of this data is provided free online for financial institutions, downstream buyers and other key stakeholders to inform their decision making, but also importantly to support a constructive dialogue with these companies and push the whole industry forward. Next slide, please. So in the palm oil sector specifically, we've got over 180 indicators that we look at across 10 different categories of environmental, social and governance risk. So we look at, as I said, publicly available information from companies only. So we're looking at their websites, we're looking at annual and sustainability reports, and then other kind of key public sources of information such as RSPO, ACOP reports. And as I said, looking at company operations, so that, for instance, the size of a company, their employees, their land bank, etc. We're looking at policies and commitments and targets related to those, but then we're also looking at reporting of progress on the ground, whether that is reported by the company itself or audited externally. And a key kind of point to make here and to keep in mind when looking at SPOTT results is that we are focused on transparency as a first step towards sustainability, which is why we're looking at publicly available information. We're not doing assessments on the ground, so this data is a look at what a company reports, but we would strongly urge combining it with due diligence on the ground and further conversations with those companies. Next slide, please. As I said, the assessment process is annual, and the engagement with the companies is a key part of this. We send all assessments to companies before publishing, give them a chance to review, to discuss with us where there are gaps and room for improvements in disclosure. And it's an important opportunity for those companies to see kind of what some of their key stakeholders are looking for in terms of disclosure. Next slide, please. So I will just go through some of the results from this year, from our November 2021 palm oil assessment, specifically looking at Indonesian companies, to try and just bring a bit of context to what we've heard so far on the climate risk and where we are currently. Next slide, please. So two key things that we look at through SPOTT indicators are here. We look at, firstly, greenhouse gas emissions commitments. So whether companies have a time-bound target on reducing their greenhouse gas emissions intensity. As you can see from, these are just general results, I should say, firstly, across all companies, not just Indonesia. But the outer ring there is showing that 22% of the companies that we assessed this year have a publicly available time-bound target to reduce their greenhouse gas emissions intensity. And given the urgency of the climate crisis and the speed with which we know the industry needs to act, quite a concerning place to be, considering that it's just the commitment stage. What is possibly more concerning is if we look at that inner ring, this is the number of companies that have published publicly an assessment of the risk of climate change to their own business, so including transition risks and physical risks. As you can see, only 7 of the 100 companies that we assessed this year have made that publicly available. If you go to the next slide, we can look at that broken down for Indonesia. So just looking at this line at the bottom here, I've split out the results between companies that operate in Indonesia but are headquartered elsewhere and companies that are both operating in and headquartered in Indonesia. I've done that because we do seem to see quite a split in the results there, and I think it's worth kind of keeping that dynamic in mind when we're having this discussion, is kind of what we mean by companies in Indonesia. But as you can see that just at the bottom there, regardless, all companies are not doing too well on this climate risk indicator. We're not seeing a high proportion of companies at all that are assessing and making that kind of climate risk assessment public. Going up one, then the time-bound commitment on reducing greenhouse gas intensity, we do see that companies operating in Indonesia only are generally performing quite a bit better here, but still either way, we're looking at less than half of companies across the board having a time-bound commitment on this. We then also look at progress towards that commitment. So here we're looking at company reported figures on their GHG emissions intensity each year and how those have changed over recent years. And again, less than half of companies are showing progress there. And then I wanted to highlight this indicator on methane capture as well, because it was mentioned in the previous presentation, this is going to be key. We look at how many mills that a company has currently have 100% methane capture. So here you can see it's around about 5% across all categories have 100% have 100% of their mills having methane capture. I possibly should have put in, and I think it's important to note that there's a much higher proportion of companies that have some methane capture across their mills, and that's quite split. I think for Indonesian headquartered companies, we're looking at around about 40% have some methane capture. For Indonesian operating companies that are headquartered elsewhere, we're looking at more like 70% have some methane capture. But to kind of focus in on the real kind of front runners here, we're only seeing very few that have 100%. Next slide, please. And I'll try and whip through a few of these just to make sure we've got time for discussion. These again, so not looking directly at climate change indicators, but these are very much relevant here in this discussion. We can see generally quite high performance on commitments to zero deforestation, and increasingly we're seeing companies reporting evidence of how they monitor deforestation in their supply chains, and so how they're monitoring that commitment. That's much higher when looking at companies' own operations versus their supplier operations, as you might expect, but is still behind where we'd like it to be. We then also look at high carbon stock assessments and whether these are available. Again, we can see that companies operating in Indonesia but headquartered abroad generally performing quite a bit better here than Indonesian headquartered companies, over 50% having high carbon stock assessments available. Next slide, please. So I'm racing through these slightly. Yes, so here we've also looked at fire and peat as obviously very relevant indicators. And I think peat was mentioned in the previous presentation. Obviously, it has a high carbon content, and so these two indicators interrelate a lot. Again, we see quite high levels of commitment, both on burning and no planting on peat. We do see lower implementation, particularly on the peat side. And I think, again, we see the same split between different companies within Indonesia. But overall, this, particularly on the implementation regarding peat, is a bit of a concerning trend to be seeing at this point in 2021. The next slide, please. So then, yeah, as I mentioned, engagement is a key part of the process, and I think you can kind of see it a bit as a proxy for how well a company is engaging on sustainability in general, you know, how seriously this is being taken by the company. So we see quite a difference here in terms of engagement on the spot assessments. Usually the companies that are operating in Indonesia but headquartered elsewhere are much more engaged with us than those that are headquartered in Indonesia, although we are seeing increases in both each year. And that's reflected slightly in the score. We're seeing average score increases we're seeing increases in average scores for companies across Indonesia over the last few years. But in general, this trend isn't really as high as quick as we'd like it to be, given the urgency of the situation. So I think I'll end there. I've only got one more slide, and I'm aware that we're coming close to time. I guess the sort of main summary from that would be that generally on indicators that are relating to how a company affects climate change, so looking at deforestation, fire and peat, we're seeing quite high levels of commitment, and in some cases relatively high levels of implementation as well being reported. But we are still seeing very low levels of commitment specifically on GHG reduction for the palm oil sector in Indonesia, and in particular we're seeing very little interest in or public disclosure of the material risks of climate change to these companies' businesses. So yeah, I'll leave it there. Thanks.
Now we will have a brief panel discussion with Olivier Tichit from Musim Mas and Vemund Olsen from Storebrand Asset Management. And finally, after that, we'll end with some questions from the audience for all of our panelists. And just another reminder that you can submit questions anytime through the Q&A function. So the first question is for Olivier. What does the analysis you've heard today tell you about the palm oil sector and how it needs to adapt? And as a follow-up, what is Musim Mas already doing and planning to do in this context?
Well, thanks, Niamh. Thanks for having us on this panel. So thank you as well. So I'll thank a lot of people, but thanks for Orbitas for the report. I think it's maybe a sobering read, but it's interesting. It's forward looking. It's business oriented. I think it's something that we are not so used to in our industry. And as for Spot, look, I think we all love Spot. I mean, we love Spot when we're high in the ranking, or we love Spot when we go up in the ranking, and we love it a little bit less when we go down or when our competitors take us over. But we love you nonetheless. Look, on the call for adaptation, yes, it's a clear call for adaptation, the report, and even what Spot is pointing out. I'd say that farmers and planters, by definition or by trade, are used to adapting. Now, there's a thing about palm. Palm is a perennial crop, so it's a strength. It's good because it's a permanent crop. It's good for soil conservation, let's say, for production. It's good for smallholders because of stability of income. The thing is, then it takes a little bit of time to adapt. It's a 25-year cycle. So normally on a plantation that's well run, you will replant 4% of that area a year. So you change quite slowly if you change your varieties. If you go faster, you upset your production, upset your mill, upset your revenue. It's not very good for business. So you keep that for very critical cases. But nonetheless, there's a couple of critical things, and I think Mark has mentioned them. I'll pick two. One on yield improvement. So that's an obvious one. The other one is maybe a bit less obvious, and it's methane capture. You've mentioned it as well, Mark, but usually it's less obvious. So as far as we're concerned, Musim Mas, look, we have a very efficient team of agronomists, and they're always fine-tuning this and fine-tuning that in the estates for optimal results. But also we have methane capture. For us, it's really a mainstay in our mills, and it's a way to address what is a bit of a hotspot in the production of palm oil, effluent. When you produce palm, you get a lot of effluent. You get about one ton for 1 ton, let's say. And it goes into ponds, and in those ponds with anaerobic reactions, it emits a lot of methane. So methane capture is quite a good way of addressing that hotspot. As far as we're concerned, we have that in almost every one of our mills. I think we have 2 mills without methane capture today. And every time we have power generation at the same time. So we can light, at this time of year, we can light a lot of Christmas trees with that. And I'll just make a footnote as to why we do not have all our mills and why other companies I know as well do not have methane capture everywhere. Sometimes you have mills which are just a bit too small. And it's not economical. It's not even technically, it's actually just borderline to have methane capture, at least with the technology which is today available. And that technology evolves. So I'll continue on the research and climate proofing, because actually they go hand in hand. I'll give a couple of examples. We choose the type of nitrogen fertilizer that we use in the field also to reduce emissions, because you have some emissions when the nitrogen fertilizer is applied. And so we can change the type of fertilizer to minimize emissions. It's a balance to find between how it's going to affect the yields, but on the other hand, how it's going to affect the emissions. Also, we have in-house research capability, and that's something that bigger companies can have, but not smaller companies. So for us, it's an added advantage because we can grow palms which are more productive. That's great. We can tap into that and we can continue increasing our yields, but also we can look at other characteristics, resilience to climate change, let's say. So it's in particular for palm water stress, which is a big problem for us. So that's what we can do as a grower. I'll try to go briefly on what we do as a processor, because first it's a lot more difficult, but also because it's a lot more complex. So what we do in a nutshell is we encourage, we assess, we support, we monitor, and sometimes we exclude suppliers. And based on what? Based on their sustainability performance. It's not only about contract performance. We also invest in smallholders quite a lot. So I would say that overall as a business, we reconsider our list of priorities in a way to sustain the business. I hope that answers your question.
Absolutely, yeah, that's very helpful. And I know it's difficult to fit in so much since you're such a large vertically integrated company. I think just to pick up as a quick follow-up, if you could talk a little bit more about the smallholder side. How do we think about, smallholders obviously are a major driver of deforestation. but at the same time, it's a major kind of initiative to uplift them politically. How do we balance those kind of goals while trying to conserve more of the forest land?
Well, I think we'll go back to that maybe as well about how the various actors in the supply chain and further downstream from us, let's say the community users and the consumers and the banks and do interact with us. But how to work with smallholders? Well, with great difficulty, I would say. There's a lot of smallholders in Indonesia. The numbers vary, but let's say 2.5 million, 3 million smallholders possibly. Just also to give an idea to people, in Indonesia, it's estimated that the palm oil industry employs 12 million people, between smallholders, employees of the plantations, the transporters, the downstream industry. So it's a very large pool of people, and they all have to follow something. I mean, so for smallholders, look, we have to find what's in it for them, I would say. So that is not easy, and we as the private sector cannot do everything. So it's a balance as well to be found between where we, the private sector, can help. So how do we help? By saying what we want and what we don't want. We do not want deforestation. We want improved livelihoods for smallholders. They're not incompatible. But it's not incompatible if, on the other hand, there is also the government playing its role, both as an enforcer, so stopping deforestation legally and enforcing it, but also enabling conditions for farmers. Access to land titles is a major item, and that's something everybody knows. It's not easy always for farmers to legalize their land. Either they planted in the wrong place and the government has to decide if it can be legalized or it has to be addressed, but also just to go into getting land titles. What for? What's in it for them again? That's where we, or at least we Musim Mas, we want to help there. We believe that as we need more production of palm oil, we cannot get it from deforestation. It has to come from yield intensification. And one of the big reservoirs of that, like as what's been said earlier, it's really smallholders. So we need to support that. So we work on extension services for smallholders directly, and also working with local governments so that we provide them the what's in it for the smallholders, or we help them deliver that. In exchange, we expect, or we hope the local governments can play their role as enforcers as well. In a real nutshell, it's not a trade-off. It's just we're hoping for that. We are trying to show that that's what's good business, basically, and that's what will sustain also their smallholders.
Thank you for the overview. I know it's a difficult topic. And I'd like to turn to Vemund now for a question. Storebrand has committed to having deforestation-free portfolios by 2025. Could you tell us a little bit more about what this means in practice and how you assess and manage risks, how you choose investments, and a little bit about how you engage with companies as well?
Sure, thank you. And thank you for two very interesting presentations. So Storebrand we're a Nordic asset manager. We invest in about 4,000 companies. We adopted a policy on deforestation in 2019, committing to have a deforestation-free portfolio by 2025, and reaffirmed that commitment at COP26 in Glasgow last month, together with the 29 other financial institutions. So I think that we're likely to see increased focus on deforestation specifically, and climate and nature risks more generally going forward. And that's because of what has been explained very well during this webinar. This is not just a moral issue; it's also for investors something that creates financial risk for the companies that we invest in, and for us as shareholders. I think so we've to fulfill that commitment, we've done an initial risk analysis of our portfolio. We're going to do that every year. There hasn't been any ready-made methodologies for that, so we've used several sort of open source tools like Forest 500, Trace, Spot, other data sources that we've included. And what that's allowed us to do is to identify companies that have a direct or indirect connection to deforestation, either through or to deforestation risk, I should say, either through their operations or through supply chains or through financing, like financial institutions providing loans, etc. What it has not done is to actually do an analysis of the, to try to quantify the financial risk, which is why I find the Orbitas analysis so interesting, and would like to see more, look more closely into, not because this is a starting point where you can look at some very important risk issues for sort of downstream companies or upstream companies, I should say. It would be very interesting to see similar sort of efforts also to try to quantify or identify risk issues for companies further up in the chain, or all the way to the retailers that source commodities that have some sort of forest risk. I think that's something that would be met with a lot of interest in the investment sector. So based on our analysis, we've identified companies that we feel are have the highest risk as we see it, and then we've identified about 50 companies to start out with for active engagement. And our what we want to do is to contribute as an investor to changes in the real economy. These commodities, palm oil, soy, pulp and paper, they're not like coal. They're not something that we can divest or want to divest. We want to sort of stay invested, but see improvements within the sector. Yeah, and to do that, we want to engage with companies. We also need to engage with governments and regulating authorities, which is why we're sort of part of this as a co-chair of the investor policy dialogue on deforestation, which engages with authorities in Indonesia and Brazil, as well as the European Union on regulations for these sectors, and I think that's key, because as it currently stands, the companies that do the right thing and improve their operations and manage to eliminate deforestation from their operations, they're still exposed to risks associated with deforestation if other companies continue business as usual. So we have to engage on several levels. I'll stop there. I think we're running a bit short on time.
Yeah, that's really helpful, though. Thank you. The next question is definitely relevant to both Musim Mas and Storebrand. So what are the main challenges in general that you face with going deforestation free as a business and also as an investor? So we can start with you, Olivier.
Thanks, Niamh. Well, I'll see it. So for us as a company, I'll see it at two different levels. One as a plantation company. As a plantation company, pretty straightforward decision. And almost the same decision, but you'll see the implications are different for a refiner, let's say, oleochem company. So as a plantation company, it's pretty simple. Do I want to be able to sell anywhere I like or not? Now, the cost, on the other hand, of that is that it's about the land I cannot use, and that's where it's difficult to put a dollar value on it. You give what is interesting, and where Orbitas have pointed us in the right direction, is to say it gives a higher value to the land which is already planted. It gives a higher value to land which is available for palm development. Look, a company like us today, we could be twice the size we are as a plantation company. We are not there. Why? Because we made certain commitments. And so that's costing us in terms of missed opportunities, if you want. But what value would have that land today to us? What would it would block us to enter certain markets, certain buyers, and maybe some banks would not even talk to us either. So it's a trade-off, and it's about what you think about long-term about your business. As a refiner or as a miller, I would say it's harder, because it's not only about having a vision, it's about having that vision, communicating it to our suppliers, to the suppliers of our suppliers, or getting them to do it. And it's about then enforcing it. And that's difficult in a moving supply base, especially if it includes, for Musim Mas, on any day, I would say, or on any year rather, we have 700, 800,000 smallholders included in our supply base. So how do we manage that? So it's a very radical change in the business model. I think it's been said in other places, it's about decommoditizing, if you want, the product. It's really about not just looking at it as price, quantity, delivery, it's about a lot more than that. In interest of time, I'll stop at that. I hope that answers your question enough.
Yes, thank you. And Vemund?
Yeah, so as an investor, the main challenge for us is, I guess, to become deforestation free in that sense is that is because forest risk commodities are present in so many supply chains and so many industries. So while it would be relatively easy to identify like the key companies you need to exclude if they're not willing to cease deforestation, it's much harder when you look at all the companies throughout the supply chain. For the companies that we are engaging today, I would say that a key issue in the dialogues, and we've been talking to companies for 7-8 years in some cases, is the lack of supply chain traceability, especially when it comes to indirect suppliers. We've been talking about smallholders. I think it's in some cases maybe even more difficult in the cattle sector in Brazil and other countries, for instance, where you see animals transported from farm to farm. So you can't just do satellite monitoring. You have to have a very good due diligence system following going through the indirect suppliers as well. That will hopefully become easier with the new proposed European Union regulation on deforestation, which requires companies that place products on the European market to provide geolocations to the point of production. I think that will be very challenging, but it certainly provides a lot of impetus to this increased traceability. And I think another challenge that's worth flagging is was what was brought up by Eleanor. It showed the low degree in the palm oil sector, but I think that applies to a lot of companies of companies being transparent about climate risk and also their impacts and dependencies on nature. So we're very hopeful that science-based targets, both for climate and the emerging work on science-based targets from nature, that's something that companies will adopt, which will allow us to analyze our risk better and to be able to separate better between companies.
Perfect. Thank you so much. And I know we're so close on time here, so I'm just going to finish with one more question. And if you want to just give a sentence or two response on what investors need from palm oil producers and what palm oil producers need from investors in order to reduce climate risks and deforestation. I know it's a hard one.
No, it's a very easy one, Niamh. Very, very easy. It's in one word: trust. And trust, and not to be missed or mistaken for blind love. It's not about blind love. That's not what we're asking for. I mean, it's great if we get it, but that's not what we're asking for. The difference is that it's about collaboration that's based on transparency, because transparency is actually good for business as well. So I'll keep at that. There are tools to do that. You've got the IRF, and SPOTT is also playing its part there. But like I say, it's about trust and not blind trust. It's about trust that's built on transparency and on collaboration.
Yeah, I'll pick up on the transparency. I think that's a key point, and to have good dialogues based on trust with companies in terms of not just the commitments that we've seen in this field for many years. Many companies have made commitments, but it's very hard for investors to sort of measure the actual progress of companies because they often report on activities rather than results. So alignment around sort of measurable progress indicators in terms of traceability, monitoring of supply chains, science-based targets, etc., I think are key issues for us.
Perfect, thank you. And unfortunately, that's all we have time for. We do have more questions in the Q&A panel. We do have your contact information, so we'll try to reach out to you with answers individually. Feel free to also send us emails with additional questions as they come up. We really, really appreciate your time today. We really enjoyed the discussion and having you here with us, and we hope you enjoy the rest of your day. Thank you very much.